Welcome to Books of Our Time, produced by the Massachusetts School of Law. Today we shall discuss a book that details underlying reasons that led to the stock market bubble of the 1990s, the collapse of the early 2000s, and huge losses for investors. Many of those reasons relating to corporations and mutual funds still exist and still threaten us today, unfortunately. The book discussing the underlying reasons is The Battle for the Soul of Capitalism by Jack Bogle. For over 30 years, Mr. Bogle has been one of the giants of the mutual fund industry. He is the founder in the early 1970s and for many years was the head of the famous Vanguard family of mutual funds. Vanguard is one of the leaders in the industry. And for decades, Mr. Bogle has been a leading critic, perhaps the leading critic, of practices that widely prevail elsewhere in the industry. Because of his founding of Vanguard, the innovations he wrought there, including so-called index funds, and the constructive criticisms he has regularly leveled, Jack Bogle has been called one of the foremost influential investors of the entire 100 years of the 20th century. Mr. Bogle is with me today to discuss his book, and I am Lawrence R Velvel, the Dean of the Massachusetts School of Law. John, thank you for coming up from the Philadelphia area. Valley Forge, is it not?
Valley Forge, Pennsylvania.
Yes,
Great to be with you.
Valley Forge, famous in history, song, and story. John, early in your book, I think it might be the very first part of your book, very first thing in your book, you compare what is happening in the American economy to the fall of Rome. What are the points of comparison that you see? Why did you do that?
Well, I did it in part to catch people's attention to the fact, or direct people's attention to the fact, that we have become a great world empire. And there's no evidence that any empire lasts forever. So that comes up in the book right at the beginning as a warning for what can happen if you get a little arrogant, if you get too
self-indulgent. A most unpopular thing to say to Americans, by the way.
It's very unpopular.
Yeah.
That's not my cause is not popularity. But the fact is the Roman Empire was the strongest power on earth, as we certainly are. They had frontiers that went basically to the edge of the water. We're surrounded by two oceans. They had a working constitution, believe it or not, in those days, as we have had here, and a whole lot of other things. I mentioned in the book that just as the Roman Empire had its bread and circuses, so do we have our bread and circuses. So it's a warning that this too shall pass away if we don't wake up and repair some of the problems in our corporate system, in our investment system, and in our mutual fund system.
At lunch with our faculty, you pointed out that you start the book, or early on you have perhaps a 10 or 15 line quotation from Gibbons on the decline and fall, and you had to change it only very sparingly to make it perfectly suitable for the circumstances of the United States.
I think the readers of the book will be amazed because I took the trouble to put the footnote showing the actual quote from Gibbons' Great Decline and Fall of the Roman Empire right at the bottom of the page where my revised quote is. And the similarities are stunning.
Yes, and you had to change it so little that you would plainly be called a plagiarism were it not for the fact that you identified who it was and gave the whole quote.
You have it exactly right.
Indeed, indeed. John, I personally have felt for quite a while now and have brought it up from time to time on our television shows that the fundamental problem, if there is a single fundamental problem, overarching problem in the United States, is dishonesty in all its forms. I get the sense that from what you say, your stress on integrity, on ethics, on morality in business and elsewhere, that you don't wholly disagree with that.
Yeah, I'm not so sure about use of the word dishonesty, but there is certainly lower ethical standards. I've never said that business conduct is, today's business leaders are less ethical than the business leaders of 100 years ago or 50 years ago, because I'm not sure they are. But what I am sure of, absolutely sure of, is the standards of what we consider ethical conduct have been greatly debased. So what's ethical now is what you have to do to meet Wall Street expectations, what you must do because everybody else is doing it, and those aren't ethical standards. Ethical standards, to me, are absolute standards and not relative standards.
Yeah. We'll get into a lot of that, John, because when one talks about stock options and the funny money accounting that was indulged to make them possible, I mean, I think this is pluperfect examples of what you're talking about. Do you feel, you talk a couple of times in your book, and you mentioned at lunch, that you wrote a thesis in 1951. I guess all seniors at Princeton to this day have to write theses.
That's correct.
And you wrote a thesis on the mutual fund industry, which, by the way, I'd like you to explain, became a book. And also, I have the sense that when writing that thesis, you formed ideas about the investment company business or the mutual fund business. Ideas which largely, I guess, reflect your own ethical background, and ideas which you have never really changed in the last 50 years. You want to comment on all that?
Sure, I think that's very fair. The title of my senior thesis was The Economic Role of the Investment Company, that is, the mutual fund. What did it do for the economy? What did it do for investors? And it occurred to me the most important theme there is the business must be beholden to its own shareholders. The role of the mutual fund, I think I'm pretty much quoting directly from the thesis right here, is to serve both individual and institutional investors. And we had the businesses that exist today is a business that serves the interest of the managers of mutual funds before it serves the interest of those shareholders who own it. And like a typical idealistic young college student, my thought was, how do you make this a better industry? And one of the quotes, which I think I can still remember pretty directly, is mutual funds must be managed in the most efficient, honest, and economical way possible. I also said mutual funds can make no claim to superiority over the market averages, which is in a way an early thought.
Yeah.
Maybe we ought to have an index fund
Yeah.
that simply represents the market averages.
Yeah.
So it was very idealistic, very impassioned, and you could argue that it's kind of sophomoric idealism at its worst, or you could argue it's the design for the firm I would create a quarter century later, a firm called Vanguard.
Well, I used to know a fellow who's quite a famous guy. I don't think I have to mention his name. And he would always worry when he went to court if he didn't win a case. He said, I lost something off my fastball. And I don't think you've lost anything off your fastball.
Well, you know, my convictions are, which I think makes them really wonderful, is they're very simple. They're the essence of simplicity. And they depend on simple arithmetic, Larry. Yeah. And I've come to call this, after a quotation from Justice Brandeis, the relentless rules of humble arithmetic.
Right.
And if investors would only understand that as a group, they share the market return, and therefore, let's say the market goes up 10%, and therefore as a group, once they've paid the cost of acquiring that return, what we call financial intermediation costs, they lose to the market by the amount of their costs.
Right.
So the central arithmetic of the investment business is that beating the stock market for investors as a group is a zero-sum game, and beating the stock market after cost is a loser's game.
Yeah.
And if people just understand that, they'd understand why indexing works, because it takes less than anybody else.
Yeah. Well, we'll elaborate that. Let me ask one other, or go back to one other question. Your thesis is one of, I gather, relatively few or very few that has ever been published as a book at Princeton University?
I'm told that there have just been two that anybody knows of.
Two in like 100 years.
I mean, yeah, as long as anybody can remember. And one of them was mine, and I should say, parenthetically, that it did not get published until 2001.
I see. They made you wait.
50 years, and you wait 50 years. They did display it in the library when it happened.
Right.
And the other happens to be an equally, maybe even more idealistic thesis by Wendy Kopp called Teach America, a thesis for the business she created, even as the thesis, my Princeton thesis turned out to be the basis for the business I created, about bringing young people out of college and into the areas of American society that really need help in teaching.
Right.
The underside of the society, the less privileged side of society.
Right. Now, John, do you think that the kind of non-fiduciary mindset, if I might put it that way, well, let's first of all define, if you will, for the audience. I mean, we lawyers know and you investment folks know, but explain what a fiduciary mindset is.
A fiduciary mindset is simply the mindset that says, my clients come before I do.
Yeah.
It's service to others before service to self. It's, in the technical sense, It's the role of a trustee of a pool of money or an estate or a mutual fund for that matter, who says, I'm not running this for my benefit. I'm putting the interest of those mutual fund shareholders, or the beneficiaries of that estate, or whatever it might be, the beneficiaries of the pension plan in a corporate sense, first. And I'm not going to take excessive amounts of money out of that. I'm not going to do things to that pool of assets that hurts those shareholders. I'm going to do everything I can to help them.
Now, I think the last thing you said is really the crux of the problem, because every lawyer, every fund manager, everybody who runs money, every architect, everybody wants to make a living. The real question is, do you not let unlimited greed get the better of you? Do you not make all the money possible just because you can make it, but instead confine yourself, limit yourself, because you have this overriding responsibility to others? You think that's a fair way to look at it?
Yes, it is a fair way to look at it. And we know, for example, in the mutual fund industry, just because of these relentless rules of humble arithmetic, that as a group, the more money the managers take, the less money the investors make. So, and in great bull markets, which is a big part of this, the kind of super stock market, the best market in the history of the nation, and for that matter in the world, average gains over 20 years of 18% per year, pretty much year after year. Let people still give a lot of money that they were investing went way up in value because it got overvalued, and not because the underlying stocks did, the underlying companies did so well. And that meant you could take a nice slice off the top, and in effect, nobody worried about it. Didn't make much of a difference in that, because the markets were so good.
Right. That's kind of typical of bubbles, I think.
Exactly.
John, you know, one wonders, as I've asked you, one wonders, how could the situation have deteriorated to the point where you see it, in view of the fact that your book has been blurbed, as they say, by an all-star cast of highly influential, highly placed people? And I don't mean just highly placed in the investing world, although that certainly, but even politically highly placed. I mean, when all these people say, this man is right and he's telling us something which needs to be said, how have we come to this pass that you see us at?
Well, I'm afraid it's simple economics, and that is the economic interests of our financial system, our investment bankers, our stockbrokers, our mutual fund managers, and all the people that are enriched in this bull market, but even up to today, who we pay $400 billion a year to, they're powerful economic interests, and they don't want to give it away. You know the old phrase, don't let them take it away? So they stand pretty much united of keeping this system that profits them at the expense of the investor, keeping it just the way it is. Let's
talk a little bit about corporations. Now, everybody knows, at least since Enron and Tyco and the WorldCom and the rest of these guys, everybody knows that one of the problems which has existed is that corporate CEOs and other very high-level guys just made a bundle off of stock options. Explain how this happened and what kinds of funny money accounting had to be indulged. Speaking of low ethics, what kind of funny money accounting had to be indulged in order to enable these guys to walk away with $2 and $4 and $800 million in profits on options?
Okay, well, to explain that, I've got to take a half a step back and say, in the long run, there are kind of two markets out there. One is the business market, and that is real businesses with real people making real products and real services with real strategies and spending real money on those strategies and earning real profits. That is what investing should be about.
That would be like a steel company or Microsoft or what have you.
If the company does well, the stock will do well. But overlaid with that is what we call the expectations market. And that is changing the expectations about what those realities will be in the future. And that's what the stock market measures. So while the growth of American business, the economic return in American business over 100 years is not so far from a straight line upward. Pays dividends every year, earnings go up much more often than not every year, probably 85% or 90% of the time, corporate earnings grow because they've got more capital in the business. But the market gets way ahead of that, as it did in 1999, and then way behind that, as it did in 2003. Just a big rise, an excessive rise, and then an excessive decline, because the market is a speculative instrument. The executives figured out, implicitly at least, that it's a heck of a lot easier to build expectations than it is to build companies. Building a company, building the intrinsic value of a company, is really hard work. Building the reality of a company. Building the illusion is like rolling off a log. So you get to manipulating your earnings, financial engineering we call it. There are many, many ways to do this. My favorite is saying, well, I told you our pension fund would be earning 7% in the next 10 years, and now I'm going to change that guess to 9.5%. That's what I think our pension plan can do in the next 10 years. And all of a sudden, your company makes $1 billion more because the cost of the pension plan goes way down and reverses itself on the company's income.
May I ask you to interject something, but I don't want you to lose your thread. When you increase the discount rate, the expected earnings rate, that means the company must put in less money to fund the pension plan,
Exactly.
Which means the money they're not putting in goes into the bottom line of corporate profits. What happens is the pension plan comes up short 30 years from now.
Or even 5, as we see.
5.
Our
Yeah.
airline pension plans have gone over to the Pension Guarantee Corp, and Pension Guarantee Corp, as a result, is, I think, $40 billion in deficit. So the problems come back to haunt you, but the CEOs that got paid for all those earnings are long gone.
Yeah, yeah. And in that case, because you're making bigger earnings by not putting the money into the pension plan, the stock goes up, the CEO exercises the option, his options, and makes more money.
And I want to just add, if I may interrupt you.
Yeah, go ahead.
What we know about stock options is almost all of them are sold the moment they're exercised. They don't hold these options.
Yeah.
What kind of a fool would do that?
Yeah.
So the idea...
Because you'd have to pay money for them.
You put up the money,
Yeah.
and then you get, let's say you put up $2 a share for your option,
Yeah.
and you sell it for $22 a share.
Yeah.
You just and the companies often finance this.
Yeah.
So they just sent you a difference check of
Right.
$20.
So you're never really out of pocket to hold the option.
You're never out of pocket at all.
Yeah.
And so we've had this canard, this ridiculous rumor that suggests that stock options link the interests of the managers with the interests of the investors. Nothing could be more false than that.
Yeah.
But people believed it,
Yeah.
and part of it was because we had this terrible aberration in our accounting system foisted on us by corporate America and given credence by the Congress of America, who demanded this system not be changed, that stock option costs are not counted as an expense. In the words of the compensation consultants, Larry, stock options are free.
Yeah. Yeah.
Well, nothing is free.
Yeah. Why are they an expense, Jack?
Well, why are they expense? Because they're if you can pay, let's say you pay an executive $1 million bonus, and instead of that you give them $1 million in stock options, the company has to go out, unless they want to dilute their earnings, and buy back those shares that they've given you at a low price, so their cash goes down. And to make matters worse, they're paying a high price. So the company's stockholder loses not once by the dilution of the options, but twice, because in an effort to make that dilution look like it doesn't exist, the company goes out and pays these inflated prices of the late 90s to buy the stock back.
Yeah. And when you pay it, well, let me see if I've got this right in a way. When the company's paying money to the guy who holds the option, the company has less money. That means all the existing stockholders own a company that has less money and therefore is worth less.
Yes, so it's all of a piece.
It's all of a piece. What were they want me to go to break. I'm not going to do it. What were pro formas and what was their effect?
Well, we got into what is called pro forma. Pro forma in the old days, let me say this by way of perspective, meant if you merged two companies, you wanted to show the records before the merger, so you had a long continuity, and so you put the records of the two companies together, and we called it pro forma. And here's what would have happened if we'd done this at the very beginning. But we got to pro forma to mean something very different. And what pro forma earnings came to mean was, here's what we would have earned if nothing bad had happened. So it's the earnings you would have had if you hadn't had to pay a lot of executive salaries. It's an earnings you would have had if one of the product lines that you were offering didn't go belly up. It's the earnings you would have had if you didn't have to depreciate your assets.
Right.
It's what-if earnings,
Yeah.
and there's no there.
It's a different world. And on the basis of these fictitious earnings, or
Yep,
whatever.
fictitious, all right.
Fictitious earnings. People say, "Oh, well, this company made $10 a share. Wow, it must be. It should sell for $300 a
Yep.
share." When the reality is, it made $3 a share. It should sell for $30.
Yep.
Something.
I'll give you a good example of this, and it's in the book. In I think the year was 2001. Verizon lost around $400 million in operating, and that's the way the books looked. And then they said, well, let's increase the return on our pension plan from, I believe, 7% to 9.5%. And they all of a sudden added $1.6 billion to the earnings, leaving them with $1.6 billion less $400 million, or a profit of $1.2 billion, which they proudly reported, in a year when the value of the pension plan fell by $2 billion.
Yeah.
Now, that's financial engineering at its highest level.
Right, and that's going to come back to haunt them if it hasn't already. Explain the quarterly earnings problem, what I think I would like to call the mirabile dictu problem, miracle of miracles.
A good pair of words. We got into asking chief executives to project for us. Why would we do the work? The company has a much better idea of what they're earning than we do. So we got into, first, we think we can earn $1.50 next year. And then we got into, as the time went on, that wasn't good enough, so we think we can earn 40 cents in the first quarter and 50 cents in the second quarter, and so on during the year, and gave out what we call earnings guidance.
Guidance, that was the key word.
Guidance.
Yeah.
And then it became really a very interesting sidelight to all this, really an interesting one. It's if a company missed its guidance, the value of the stock might drop by billions and billions of dollars. The stock would take a big drop, maybe from $40 to $32 a share.
People would say, oh my God, they're in trouble.
And the reason they thought that was pretty good, and that is, with all the financial engineering going on, if they can do all that and still not get to what they promised, they must be a troubled company. So the market wasn't actually entirely stupid. But what happens is there are so many little things you can do in inventories and the way you write off debts and the way you account for your pension plan, that you almost always made your earnings guidance quarter after quarter after quarter. So you met expectations. But business, that's the difference between the expectations, Mark. Remember, that's a very, very different thing, and the business markers that you have to meet.
Yeah. I mean, we've been reading about companies where the CEOs went nuts because they were going to miss the quarterly earnings by a penny, and he foresaw the stock dropping right through the floor because they missed it by a penny. Mm-hmm. And I think you said in the book that somebody estimated that GE's ability to hit its quarterly earnings on the nose for 20 straight years had the odds against it of 1 in 50 billion.
Well, it was a lot of billions. That's exactly right.
Oh man.
And you know, the interesting thing about it, and this is really an interesting point. GE has done very well in the last 4 or 5 years. Their earnings have grown. Jeff Immelt seems to have done a nice job managing the company. But the loss in General Electric, the capitalization value of General Electric stock, has dropped by more since its high in early 2000 than the combined loss of value in Enron and WorldCom, which have gone bankrupt.
Wow.
It's something like $250 billion of lost market cap. That's an expectations loss and not a business loss.
All shareholders' losses.
All shareholders lost.
Yeah.
Except the executives who got out by selling their options at the high.
Yeah. They're going to send Mighty Joe Young for me any second if I don't take a break. We have to take a break. Stay with us. We'll be right back with more from John Bogle. Welcome back. John, why did investment banking and brokerage firms and security analysts go along with all this funny business?
I guess the simple answer is because it made them rich. I mean, I don't mean to be too crass about this, but think about it. A lot of the big money in investment banking and in the securities firms is made through investment banking. And investment banking is deals, underwriting the securities of corporations, stocks, bonds, whatever it might be. And so the security analysts for the firms, for example, are supposed to be looking at, let me say, a good example of this is WorldCom. And they're supposed to be saying, we know this company well, and it's a real turkey. However, the
Which
firm,
they were saying privately, no doubt.
Oh, absolutely.
Yeah.
But publicly,
Yeah.
their company is the investment banker for WorldCom. So they say, this stock is going through the roof.
Right.
It's got good management. Our guy, our investment banker, is on the inside. He even meets with the board of directors, and he knows what a great company this is.
Yeah.
And it's just a profound conflict of interest that permeated Wall Street.
Yeah.
This desire to sell something.
Yeah.
And you don't have to be, this doesn't intended to be necessarily a negative comment about Wall Street, but Wall Street is a giant marketing machine.
Sure.
That's what it's designed to be. It's designed to bring the capital of investors into connection with the capital needs of entrepreneurs, factory builders, technology companies. That's what they do. So when these companies need money, they go out through Wall Street to these investors. So they have to raise money. And the problem, I think, is to have the investment analysts get paid by the profitability of the underwriting department rather than by how well the recommendations do.
Yeah. Yeah.
That's changed somewhat after the tremendous scandals that were involved with.
Yeah.
This is not, I want to be very clear on this, as I point out in the book, this is not some marginal group of investment bankers that got into all this trouble and had to settle for several $1 billion with Attorney General Spitzer in New York. This is 10 of the 12 largest underwriting firms in America, largest investment banking firms, and I think all of the top 8.
Yeah.
This is not something you can hide. This was the way the business was conducted.
Yeah. Yeah. John, it is popular in America today to say in a variety of contexts, it's just a few bad apples. No, it's not.
Please.
Yeah.
It's not, and I try and document that. I'm the first one to admit, in the book, I'm the first one to admit that the actual real wild frauds, the WorldComs and the Enrons and the Health Souths and the Adelphias, I could go on for a little while longer pretty easily, but that is a few bad apples. But the problem is the whole barrel of apples has some serious issues in and of itself. For example, as I point out, we know right today that at least 1,500 firms were managing their earnings and doing financial engineering. How do we know that? Because by hindsight, they've had to restate those earnings. 1,500 restatements, I think, is the number that I've documented in the book by some very, very large corporations, some of the biggest corporations in the entire world.
2002 to 2005.
2002 to 2005, yes, sir.
Yeah.
And it's not over yet.
Right.
And some of them had to do it for 2 or 3 years. And yet, one wonders, even as one knows the answers, when a company restates its earnings to a much lower number, how many of the executives that got great big bonuses based on those original earnings, now reduced, gave back a penny of them? As far as we all know, no one gave back a single penny of those ill-gotten gains.
You know, John, that brings up something which I know you feel strongly about, and which was discussed at lunch and is becoming a big topic today. When you see people doing this, making packages up to, you said in one case, 800 million, certainly, you know, numbers like 200 and 300 million for these executives trip off the tongue, and they don't even have to give it back. And the average worker the pay of the average worker in real dollars has gone up in the last 35 years by, what did you say, 1/3 of 1%?
0.3%, but roughly 1/3 of 1% per year, in fairness. 7% for the 25 years.
Yeah.
But the compensation of the CEO has gone up about 800% to something like, in real dollars, it's probably 12 million a year or something in nominal dollars, about $4.5 million in 1980 dollars. And so what those CEOs are telling us is that I have created all the value in this company, and you, our workers, have created virtually nothing.
Yeah.
And I will tell you, Larry, I was a CEO of these companies for the better part of 30 years, maybe more than 30 years. And as a CEO, I know that not to be true. The most valued asset of any company is the hardworking people who get their duffel bags out of bed in the morning and come to work, give an honest day's work for an honest day's pay, and go home Friday afternoon for the weekend without any hope of getting these staggering rewards.
You know, it's kind of ironic and kind of funny, John, but because a group of us started our law school 18 years ago, and because I've been the dean since then, and I was the only educator involved at the time, people seem to think that I am responsible for creating and building the law school. I keep saying, no, not true. You know, we've got another 8, 10, 12, 14 people here who were vitally important in it, and God forbid, you know, one should ever say anything different from that as far as I am concerned. Because I agree with everything you said. It's not true. It's bad for morale. It's bad all the way through. And yet that's the way some of these egotists have been on Wall Street, I think.
Yeah, I'll tell you a funny little story about that. And that is, we've had the age of the imperial CEO, and I was on a conference board commission on public trust and private enterprise, run by the wonderful Pete Peterson,
right.
And former Secretary of Commerce, a truly great man in America. And I said to one of the CEOs, a very good one, by the way, I'm not faulting him, I said, don't you realize you're just an employee of the company? And he got red in the face, and he said, he was about to say, don't be silly, and he might have even gotten the first part out, and then all of a sudden he gave a great big sigh and said, you know, you're absolutely right. Because of course the CEO is an employee of the company. And he gets a little arrogant. He gets his picture on the cover of magazines. He gets paid in ways, gets airlines, his own private airplane that takes him and in some cases his dog, a separate plane for the dog. We have that here too. And goes down to Augusta to play on the master's course with other CEOs. It's not a good system.
John, why did Congress go along with this? You even point out that they insisted that Wall Street continue some of these terrible things. How did that happen?
Money.
Money.
Money. Business lobbying power. Dollars and cents. Powerful influence that our corporations hold. I've often said that there is no investment that a corporation makes that has the same return on capital as political contributions. You know, they pay these little 100,000 here's, 10,000 there's, 25,000, 2,500. And they get a tax break worth $100 million. I mean, it's infinite. So in one of the cases that's pretty well known, the SEC, Securities and Exchange Commission, and the Financial Accounting Standards Board wanted to require options to be expensed. Something you would think was so logical, as we talked about earlier. And led by Senator Lieberman, the corporations got into the lobbying effort, and led by Senator Lieberman,
St. Joe?
St. Joe, the United States Senate passed by, I think it was basically an 85-5 vote or something like that, an overwhelming vote, that if they did that, the FASB would be, Financial Accounting Standards Board, would be put out of business. And so they backed down. And the SEC backed down.
You know, you were saying that, I think I heard you say that the lobbying costs were minimal for the benefit gained, and I think you said in the book, paraphrasing Churchill, never have so few paid so little for so much. You know, it's a funny thing. I've seen it in my business. Boy, you can buy off people. Sometimes the phrase is for a bottle of wine. I mean, you know. All right, let's get into intermediation. Would you explain in a couple of minutes we have left for the second segment, what is intermediation?
Well, it's a kind of a dull term that is telling us the most important single story about what has happened to capitalism. And that is, we have moved from owner's capitalism, traditional capitalism, where the owners who put up the money and take the risk get the rewards, to a new system. I call it in the book a pathological mutation, to a new system of owner's capitalism, where the owners have moved into the back seat and the managers with the cooperation of other managers, the CEOs of other corporations and accountants, have taken over and gotten far too large a share of the rewards. They control the companies now, these managers do, and the investors do not. How could that happen? It happened because we once had, when we had owners' capitalism, what I call an ownership society. And in 1950, 92% of all stock, nearly all stock, was held by investors, individual investors, and 8% by financial institutions. Today, financial institutions own 68% of all stock, and individuals are in the minority. So these financial institutions aren't owners. Think about it. They're agents for the owners. They're agents for the owners, and their interests are not those interests of the owners.
Yeah.
Their interests are their own interests. Yeah. How to keep the corporation's business in their 401k plan. Right. How to manage those mutual funds and get large fees, because it is a fact that pension funds and mutual funds own over half of that 50% of corporate America, out of that 68% that all institutions together own, even more than 50%. And they have their own interests to serve. And to make matters worse, they aren't owners anyway.
Right.
They are traders and speculators, because instead of holding stock on average for 6 years, as the mutual fund managers did when I came into this business all those years ago, they now hold stock for less than 1 year on average. Yeah. So we changed an own-a-stock industry into a rent-a-stock industry. Yeah. And renters don't care about corporate governance. Yeah. They don't care about business. They're trading so rapidly. They're working in the expectations market and not in the market of business reality.
Their only concern is that the price rise within the next few months so they can sell out and make a bundle.
Exactly. Yeah. And of course they're selling out to their other institutions. Yeah. So there's no gain except to the people in the middle, but that's another story.
Yeah, yeah. Now, let me see if I have some of this straight. You or I might own shares in a mutual fund. Mm-hmm. The mutual fund then owns shares in the corporations. Mm-hmm. So in a sense, the mutual fund is intermediate, to use that dull word.
Exactly, that's the word.
And it is your view, which seems very hard to fault, and I know it's being accepted more and more, that as the intermediate, the pension funds and the mutual funds ought to exercise control over the corporations in order to stop the corporate managers from raping the corporations and doing other bad things. Mm-hmm. But they are not, because they benefit from the corporations. They, for example, run for great sums of money the corporation's pension plans and other things. And so the person who gets left out, or whose interests get run over, is the original investor who owns shares in the mutual fund or has an interest in a pension fund.
Yeah, well, that's certainly one of the major contributing factors in my judgment. Of course, the mutual fund industry denies it. They say they vote properly no matter whether they're in the funds or not. They're not very active voters.
They have the gall to say that with a straight face?
Well, they do have the gall to say that, yes indeed. But the other reality is that if you're a stock renter and not a stock owner, you don't care about corporate governance. The corporate governance can change the business, but not the expectations. Yeah. So they're working in this wrong market. Yeah. And I have a wonderful quote in this book which really summarizes the whole thing, and that is, when we have strong managers, which we do, when we have weak directors, which we do, and when we have passive owners, which we do, don't be surprised when the looting begins. Yeah. And we haven't had very much real looting, as in those cases I mentioned before. But we have had what is not so far. I mean, if the difference between running the company in the interest of the managers and paying that kind of compensation, giving that stock options huge shares of ownership, certainly is not looting, let me be clear on that. But on the other hand, let me be equally clear. It's not totally different.
Yeah. And there was a philosophy involved that goes something as follows. Well, in terms of the corporate democracy that we allegedly have and we are supposed to have, forget it. Don't worry about corporate philosophy, corporate democracy or corporate governance. If you don't like the company, sell its stock. If you don't like the mutual fund, cash in your shares and buy another mutual fund. Whereas you take the position that this is very short-sighted in a number of ways, including good governance and reputable democracy creates good business results. Is that a fair statement?
Well, that's a fair statement, but I go even further. You know, think of what the executives will do if they have no one overseeing them. In other words, if you lose oversight, if you lose, as I put it James Madison kind of terms, he said about government, if men were angels,
Right.
no governance would be necessary.
Right.
No government would be necessary.
Right.
And I would say, if CEOs were angels,
Yeah.
no corporate governance would be necessary.
Right.
And so it's a separation of powers issue.
Yeah.
And the problem is those that have the power are dead set against giving it up, and those that should want the power are these institutional investors. Look the other way, turn their back on wanting it. They're doing nothing to have a strong ownership position.
We are going to get into the position, the odd position. It's kind of like the strange career of James Crow, if you know that term by C. Van Woodward. The strange position of mutual fund management companies in American society right after this break. Stay with us. Right after this break, we'll be back with the last segment with John Bogle. Welcome back. John, explain, if you would, a most unusual phenomenon, the structure and relationships between a mutual fund management company on the one hand and the mutual fund itself on the other, because in reality the mutual fund is a shell, isn't it?
Yeah, you use the word unusual. I would use the word bizarre. You kind of wonder where it all came from.
Yeah.
And that is the mutual fund manager creates the fund, pays its officers, selects its independent directors and its non-independent directors. An awful lot of the mutual fund directors are working for the management company and getting paid by the management company.
Yeah.
Provides the funds with all the services it needs to exist: administrative services, distribution services, investment management services. And all we have for the fund is a shell that holds the securities in the portfolio: General Motors, Enron, whatever it might have been, IBM, Microsoft, and so on. So the mutual fund is the captive of the manager, and the manager has great flexibility in the amount of money the manager charges. Now, I want to be very clear on this. There's a law that governs the operation of the mutual fund industry. It's called the Investment Company Act of 1940. It's been amended once or twice since then, but not in the ways that would be substantive to these comments. And that act says mutual funds must be organized, operated, and managed in the interest of their shareholders and not in the interest of their managers and distributors. That is what the law says, and that is the diametrical opposite, the 180-degree difference in the way the fund industry actually operates.
Yeah.
So we now have created these giant mutual fund management companies that are, often owned by great big financial conglomerates. And those financial conglomerates, as everybody knows anything about the corporate world, come into the mutual fund business not to earn a profit for you, the mutual fund shareholder, but to earn a return on their own capital that they put into the business.
Yeah.
Paid a big price for it because they paid a big premium. They got just a very tiny amount of book value for that huge amount of market value, because this is an incredibly profitable industry in terms of profit margins. Unbelievable. 50% pre-tax profit margins, 40% pre-tax profit margins, and so on. So we have an industry that belies both common sense and the policies established by the Congress and the administration of the United States.
Yeah. Yeah.
And a lot of what's going wrong is based on that complete dichotomy.
Yeah. Now, explain two things about that, which seem to me, at least as a layman, to more or less go to the heart of the problem. One is that the management company charges the mutual fund, which is its complete captive, on average, let us say, 1% of the fund's assets as a management charge every year. And that is true whether the fund has $10 million in assets, $100 million, or as some of them do, $50 or $80 billion.
Or $500 billion, or $1 trillion.
Or $1 trillion. And the costs don't go up proportionately.
They do not. The economies of scale and investment management are staggering. Doesn't cost that much more to run a $10 billion fund than to run a $1 billion fund. You must
Maybe you hire
understand
3
that.
analysts instead of 2.
Yeah, but those economies of scale have been arrogated to the benefit of the management company and not to the benefit of the fund shareholder. And I would call that, simply put, a breach of fiduciary duty.
Right. Now, the other thing, which is pretty staggering, is that once the SEC was forced by the courts to rule, courts have a long history of doing bad things, in 1958, that the management company could be sold because this allegedly was not a misappropriation of the value of the fund itself. Well, the management company, which is getting 1% on all these assets, maybe on a $50 billion worth of assets, on which 1% is $500 million a year,
Yep.
the costs are maybe 30 or 40 million a year, it can be sold. So
And is.
And is sold, yeah, to these conglomerates. And
the public. Actually, there are only, among the 50 largest management companies today, there are only nine that are privately held, and 41 that are either publicly owned by the vast investors, or mostly 34 or 5 of them that are managed by financial conglomerates. These
Yep.
companies that are in business to earn a return on their own capital, which is what a corporation does.
Yeah.
It's almost not
Yeah.
wrong,
Yeah.
just
Yeah.
wrong in this business.
now, do I have the following right? Because it's a staggering example of something. There was a fellow who, for many years, when I first started following this, was a very famous mutual fund manager. His name was Richard Strong.
Mm-hmm.
And he got hit by the SEC. I mean, his funds, he owned a management company and was an analyst besides, I guess. And his management company just got hit tremendously by the SEC because they were doing illegal things, which he was doing because it made money for him. To the point where he got kicked out of the business by the SEC. He cannot be involved with the securities business anymore. And he still sold his management fund for what, $400 million?
Well, they say it was $400 million.
$400 million. Yeah. Well, that really tells you something. When you can be kicked out of the business for doing illegal things and you still walk away with $400 million because you can sell the business you've been kicked out of.
Well, you know, the crazy thing about it is that they sold the business ultimately to Wells Fargo, the banking enterprise. And if before all this happened, the directors had said, look, Dick Strong, we don't think you're doing a good job and we're going to hire Wells Fargo. They could have hired Wells Fargo for 1/10 of what they were paying Dick Strong.
Yeah.
But they didn't do that. Then Dick Strong, in effect, sells his company to Wells Fargo, and the directors say, oh, we now love Wells Fargo, and he says, I love Wells Fargo, you should use Wells Fargo. He gets his $400 million, but because all that money is tied up there, Wells Fargo has to charge the expensive rates to get a return on their capital.
Yeah.
I mean, it's also transparent.
Yeah.
And also wrong.
Yeah. Now, you have a phrase in the book which I'd like you to explain in detail. The phrase is, in this business, the investor, when speaking to the investor, quote, you get what you don't pay for. Would you, that's a classic. Yep. Would you explain that, please?
Sure, easily. And that is, all investors are, I'm glad you're sitting down, average. That is to say, that is
or less.
Yeah, well, no, they're average. They can't be less than average. In a 10% market,
yeah.
we all as a group divide up 10%.
Yeah.
In the mutual fund and in intermediation generally, we give up about 2.5 percentage points, it looks like, to financial intermediation. Costs around $400 billion a year, as I think I mentioned earlier. And that means that in a 10% market gross return, we actually pocket 7.5%. There's no way around that. Gross return on the market minus the cost of intermediation is the net return investors divide up. It follows, and we've done lots of studies in the mutual fund industry that show that you not only don't get what you pay for, you not only don't get what you pay for, and you don't quite not get what you pay for, you get precisely what you don't pay for, and therefore, if you pay nothing, you get everything. And nothing is essentially what you pay for a stock index fund that buys the whole market and holds it forever.
Yeah. Now, as I understand it, John, if you assume that the market is making 11%, and a non-index fund, what they call an actively managed fund, will make a little less than the market because, well, transaction costs. I'll let you explain that. And then the investor himself or herself will make a few percentage points still less. I'll let you explain that. And the amounts of money involved that the investor does not make because of these costs are just utterly mind-blowing. Why don't you elaborate on all this?
Sure. The precise examples are, of course, in the book, but let me just say very roughly, in the last 25 years, the Standard & Poor's Index, 500 stock index, essentially the value of what corporate America, the market value of corporate America, market capitalization of corporate America, has been 12.5% a year. Not every year, but on average. The average mutual fund has costs of around 2.5% and has therefore earned about 10% a year. But mutual fund investors...
What are those costs? Transaction costs of selling stocks?
Tell you exactly. The average equity mutual fund, which I'm talking stock funds here, has an expense ratio averaging at 1.5%. When you turn over your portfolio at 100% a year, which is what they do on average, the turnover costs paid to Wall Street are something like 1%.
Okay.
Then most funds are sold with the sales commissions, and if you pay a 5% sales commission and hold the fund for 5 years, that's another 1%.
Okay.
I'm already up to 3.5%.
Yeah.
But I'm only using 2.5%.
Yeah, right.
I want to give the industry, of course, a fair shake. But what happens is that when, at the beginning, for example, of this period, during the 80s, when stocks were cheap, investors bought almost nothing in the way of equity funds. And certainly not after 1987, after they had the big crack. By the time we get into the late 90s and stocks have boomed, $400 or $500 billion pours into equity funds year after year at a very high level in the market. And then when the market drops way down, drops 50%, almost no money goes into the market. So they have a very bad record in terms of market timing. They like stocks and fund investors when they're high and hate them when they go down, when they're cheap. Kind of dumb. And at the same time, they make bad fund selections. When that $500 billion or so went into the fund industry in 1999 and early 2000, they were buying internet funds, telecommunications funds, technology funds, all those new economy things, which went down even more.
Which the management companies made a fortune from.
Which they made a fortune from, and they brought them out like they were selling new potato chips or something. So the management companies contributed greatly to all this. Yeah. Because of marketing business, and in marketing the idea is to sell people what they want. Yeah. And they want what's hot. They shouldn't, but they do, and the management companies make that worse instead of fighting against it.
You have some examples, and you talk about a person, 20 years old, with a 60-year life expectancy still, who might start investing now. And if the person makes 7.5%, I think was the figure, over the course of the next 60 years, due to the magic of compounding, which is a whole lot. You know, Einstein was asked, what's the greatest human invention ever? And he said, compound interest. Due to the magic of compounding, that will be worth something like $132,000 when the person passes away. But if you subtract costs so that what the person's really making is 5% a year, it's only $37,000. Well, that illustrates, doesn't it? I realize that you might want to spend it. You'll have some similar figures for age 70 or age 65. Wow, people are losing, not just in percentage points, but people don't necessarily understand what the percentage points translate to in real dollars. And it's staggering.
Yeah, well, the example that you give is pretty close to what's in the book. It's an 8% compound return that grows to about $145,000. And I call that the magic of compounding returns. I want to emphasize the word returns. The reason it drops down to 32% after you pay 2.5% of cost, $32,000 from $145,000 roughly, is because of what I call the tyranny of compounding costs. And it turns out, simple mathematics, the relentless rules of humble arithmetic again, that the tyranny of compounding costs overwhelms the magic of compounding returns. So a single message investors should learn is get costs out of the system. Yeah. Or quoting the great Buffett, the investor's two greatest enemies of the equity investor are expenses and emotions. And emotions is that bad timing and bad fund selection.
Yeah, yeah. There are about 3-4 things more I'd like to talk about, but I have to wrap it. Thank you for coming from Valley Forge.
Great to be with you. Nice to see you, Larry.
Appreciate it. Ladies and gentlemen, you've heard from one of the giants of one of our major financial industries. Enlightening, is it not? Be with us again next time for the next chapter, the next segment of Books of Our Time. Thank you for being with us today.